Hi, I'm Patu from freefincal, and in this video, let's discuss about Gilt mutual funds. What are they? How do they work? When to use them? When not to use them? And more importantly, a question that many people have asked me during the last few weeks is, or months rather, I would say, after all these credit problems and debt funds, can they be used as a replacement to ultra short-term funds or any other kind of corporate bond funds or bank or even banking and PSU funds? So first of all, we'll start with what is a gilt. A gilt is essentially a bond issued by the government, and since it is the government, there is as such no credit risk, because if the government fails, then everything else around us will fail. The government does not fulfill its debt, then basically it means the country has failed. So normally there is no credit risk associated with such bonds for resident investors. For international investors, every country will have its own credit score, and they will have a interest spread based on that credit scores. But for resident investors, there is absolutely no credit risk associated with a government bond. They are called gilts because the first government bonds issued by Britain had gilded edges. That is the paper. If that was the bond paper, the side was gold coated. So you may have seen this in old books. So if you see the side, all the gold, the edges, the paper would be gold, and the side would be fully gold in color. So that's why it's called a gilt. So that's a bond paper with gilded edges. So that's how the name came. So currently there are now two debt mutual fund categories that can invest predominantly in gilts. One is called the gilt category, where there can be 80% of government securities in the portfolio of a debt mutual fund, and the maturity can be anywhere. It can be from overnight to decades. Government bonds have a maturity from 1 day to basically like a repo, what they call the repo bond. We'll talk more about that in a different video. From 1 day, it can be like 30-40 years. So gilt mutual fund category, the gilt funds can invest in bonds across duration, and this is actually a problem for investors, and we'll talk about that. Then there is another category called gilt with a 10-year constant duration. So this means that typically it will buy only 10-year bonds. The reason why 10-year is chosen is because this is a benchmark index. The 10-year gilt is the benchmark index for determining long-term interest rates like PPF or the Sukanya scheme or any other long-term small savings scheme. The 10-year benchmark is the 10-year bond is the benchmark, and therefore this is like a benchmark index fund. Of course, it's actively managed, so it will not have it will not have low expense ratio. Still, it is more or less like a debt index fund. These are the two categories, and there are only like two, three bonds in that category. I forget, I'll have to check. So there are like 2-3 debt mutual funds in the 10-year category, but the gilt has got a few more. And the first thing you should understand is that although the debt mutual funds do not have any credit risk, that is, the vertical drop in the NAV will not be there for the debt funds typically. Of course, there can be certain circumstances. We'll talk about that. Their predominant risk in a gilt fund is what is known as the interest rate risk. So what will happen is that when people think that RBI is going to increase interest rates, the existing bonds will fall in value. So whenever there is a perception, even though the RBI has not actually increased rates, whenever there is a perception that the bonds, the new bonds with higher interest rates are going to be issued, the old bonds with lower interest rate, they will lose value, and therefore the NAV may not fall, but it will kind of not move up, and it will kind of go slowly down. So and vice versa, when there is a perception that RBI is going to lower interest rates, the old bonds will become valuable, and the funds can go up because the market value of the current bonds are going to go up. So the NAV of any debt fund, particularly Gilt, it depends on two factors. One is the market value of the bonds, and of course the interest income from the gilts themselves. But that interest income is trivial. It's a very small income. It can never, since there will be typically no default. It will be a small upward movement. That upward movement is basically like background. Don't worry about that. The primary risk comes from the demand and supply of the gilts in the market. The gilt segment of the market is the deepest in India, and it's heavily traded. But still there can be demand and supply, and you can still lose money in a gilt fund because it has got a long-term maturity. So what I will do is to show you examples of this interest rate risk using one fund called the, let's take Kotak Gilt Investment. This is the oldest debt mutual fund. And the first thing I want to show you is, if you go to the scheme document of this fund, the first thing I want to show you is the risk-o-meter is moderate. So if you look at liquid funds and overnight funds, the needle will be here low. All other income funds, credit funds, corporate bond funds, the risk-o-meter will be here. Please recognize this risk-o-meter does not factor in credit risk. It is only day-to-day volatility. And so you can see it has got a moderate risk, and moderately high is diversified equity. So in terms of risk, the risk associated, the day-to-day volatility associated with the gilt fund is only one notch lower than that of diversified equity funds. That's very important to recognize. The second thing you should look for in a scheme information document is the asset allocation pattern. And as per the SEBI category rules, 80% will go to government bonds across maturity. So essentially what will happen is that typically now all gilt funds are dynamic bond funds, which will predominantly buy only gilts. So depending on the interest rate movements and the perception of the fund manager, the fund can invest predominantly in short-term bonds, or it can invest predominantly in long-term bonds. When they feel that the interest rates are going to fall down, they will be more in long-term bonds. When they feel the interest rates are going to go up, they will buy short-term bonds. So they will essentially act like dynamic bond funds. All gilt funds in that gilt category are going to be like dynamic bond funds. Of course, the gilt funds with the 10-year constant duration will not act like a dynamic bond. The 20% allocation that you see, 0 to 20% that you see, this is very important. This has to be in the cash or the overnight bond segment, like money market or the repo. That is essentially like very short-term government securities. Tri-party repo means another person will be involved, like the clearing corporation, CCIL will be involved in facilitating the bond transaction. That's called a tri-party repo. So these are going to be CBLO means collateralized. What is this? Collateralized borrowing lending obligation. What is it called? I forget. Let me just check. These bond terms are. These are a lending again. It's a very short. So collateralized borrowing and lending obligations. So I was right. I forget sometimes these bond terminology. Sorry, it's sometimes you tend to forget it. So you should always buy a gilt fund that invests in extremely low risk investments like the ones shown here. The interest rate risk will be low, the credit risk will be low. For many mutual funds in the gilt segment, this risk profile of this 0 to 20% segment can be low to medium. If it is low to medium or medium, don't buy those gilt funds. They will be more volatility and they can be subject to credit risk. So you should buy only funds that invest in cash, essentially cash or overnight bonds, which have very low interest rate and credit risk. Of course, the scheme document can say it can invest 20% in foreign securities and so on. Well, that is a chance you have to take because all scheme documents will have a clause like this. So you will have to, and unfortunately, I hate to say this, whatever debt fund you buy, you must look at the monthly portfolio, keep an eye and see what the fund manager is doing. This 80% you don't have to worry too much about because it's more or less safe. But you should look for this 20%. If you look at the Kotak fund, I think, sorry, do they have a, oh sorry, if they have a, yeah, the Kotak website, there it is. If you have look at the Kotak website, they have a nice pattern of where they are investing, what they are doing, and so on. So it's quite okay. It has something. This is cash. This is the money market investments, and that's most of it is sovereign bond. So typically you can have a look at it, or please look at the fact sheet. It's much better. Or you can look at money control. That's that's also a more convenient. I think it contains all the portfolio listings. So this is very important while choosing a gilt fund. When should you choose a gilt fund? So that's the first question you should ask. So to understand that, go to the portfolio segment of any gilt fund that you want, and notice the average maturity is 14.26 years. That is very, very long. So you, if for this kind of fund, you must, and they are using, they are into such a long maturity bonds because the interest rate has gone down, and they expect maybe one more reduction. So that's the kind of reason why they are there. And the modified duration is 7.46 years. This means for 1% change in interest rate, the NAV can go up or down by 7%. So please be careful. The interest rate risk will be very high in this. It can work in your favor or against your favor. And more importantly, I'm not talking about sudden movements. The NAV will not move at all. It will gradually be flat or just keep going down and down and down for months and months. I'll show you. That is the reason why you should be careful with respect to gilts. Buy them, use them only for long-term goals like 15 years, 20 years, 25 years. That kind of investments, use this. And you may say, why can't I use PPF for it? Yeah, there are certain situations where you cannot use PPF. Of course, you can take a chance suppose I have an 8-year investment or 9-year investment, 10-year investment. Yes, you can take a chance with this fund, but don't put all your money in it towards the end of the goal. You may have to pull out from it. So you have to be careful. There are risks with it, but do not buy gilt funds unless you are ready to rebalance regularly. So we'll talk about, so that's the main thing. If you are worried about duration and I say, okay, I have a 20-year goal, then buy the 10-year constant gilt fund. That's also fine, but look at the 0 to 20% asset allocation, where they are investing and how they are investing. So I'll show you the performance of this fund. You can understand what I mean. This is the oldest gilt fund in India as of now. I don't think there's any other fund as old. This was since 99, I think it has been in operation. So look at the annual returns first of all, and the reason why I keep saying rebalancing is important. So look at when the equity markets crashed in 2008, this fund gave a return almost 29%, 28%. That's when you should have rebalanced in the next year. 2009, the equity market boomed and this person gave -5%. So you must be ready for it. And notice that this fund gave nothing. It gave like 0.7%, 7%, 15%, suddenly 5%, so nothing again. So it will be up and down like this. Sequence of returns matter a lot in any debt fund, but especially in gilt funds because the volatility is higher. So you have to be ready for this kind of ups and downs, and you have to be ready for this kind of sequence of returns. Otherwise, don't buy gilt funds, and you must be ready to rebalance and take advantage of this sequence of returns up and down. They may not always anti-correlate with equity. There is equity goes up, gilt goes down. It may not always be like that, but whether it is or not, you must rebalance and reduce the overall risk in your portfolio. So a gilt investment is only for the mature investor who looks beyond returns, looks at the portfolio growth, looks at the portfolio value, and reducing the overall portfolio risk. And that's essentially what I want to say. Let me have a quick look. So look at the gilt fund space. When should you use the 10-year bonds? So I have the some notes from the post I wrote. This fund has got a AUM of about 445 crores. This is okay. I like the asset allocation in this fund. So you can choose this kind of a fund. Look at the 0 to 20% investment. They should be low and medium. So be careful. So if you look at, for example, if I look at UTI Gilt Fund, that 0 to 20% asset allocation says low, risk profile says low. ICICI Gilt is low to medium, HDFC Gilt is medium to high. Don't buy HDFC Gilt for sure. because that 0 to 20% has got a risk profile of 0 to a medium to high. That means that portion can experience a credit problem. Same with ICICI, it's on borderline. So buy something like QTI Gilt or this one where the that other 20% it has got a low volatility, low interest rate and credit risk. It should be predominantly in cash, money market, or also involving gilt securities to a large extent. Then you can buy, but use them only for very long term goals with a clear indication, that with a clear understanding that you must rebalance, not forget about all taxes and everything. And if you look at the NAV, see the NAV, there'll be for large periods the NAV will see that. Look at the NAV here. It's got nothing for months and months and months and months. I have to get rid of this. So for months and months and months and months, you can see. Excuse me. You can see this from this point to that point. The NAV, that's more than a year. For like 15 months or so, the NAV didn't do anything. So you must be ready for this. Must be ready to face such issues. Also, if there is if suddenly tomorrow, let's say the rupee has weakened and RBI decides to increase the interest rate by 2% or 1% like it did in July 2013, then for example, I will show you that it should be here. That's the crash here. See, this is the crash. That's the bond crash in July 2013, August 2013. You must be ready for such crashes as well in the Gilt Fund segment. So you have to be ready. The NPS also had suffered a crash like this. So you must be ready to do this. I think a Gilt Fund is only for mature investors, which means very few investors automatically. So that's what I wanted to say in this video. If you have any questions about Gilt Funds or any other debt fund, please leave them as a comment below, and I'll be happy to answer if I can. Thank you. Bye-bye.